Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and lately I've posted a lot of negative stuff about Realty Income, which is one of the most popular REITs in the entire world. In short, I can summarize my criticism about the company in 5 points. The first issue is that I fear that the REIT is getting too big for its own good. Historically, the company has achieved most of its growth by acquiring new properties, but now the company owns already over 13,000 of them, and growing from this larger base is going to be a lot more difficult in the future. Then the second issue is that the company is now stepping outside of its circle of competence by investing in new geographies and other property sectors. The REIT market typically punishes such behavior with a lower valuation multiple because most investors prefer their REITs to specialize in one specific niche and become experts at it. Then the third issue is that most of its leases only include limited rent hikes, about 1% per year. In comparison, some of its close peers in the net lease sector enjoy far better rent escalations. A good example that I recently highlighted on this channel is called YCHARTS. It has CPI-based rent adjustments in its leases, and as a result, it's today enjoying about 4 times higher rent growth than Realty Income. The fourth issue is that because of its large size, Realty Income is now doing more and more portfolio acquisitions instead of single asset acquisitions, which don't really move the needle anymore. The issue with portfolio acquisitions is that you're buying a basket of assets, and so you always have some good, some average, and some bad assets in the mix. Therefore, I fear that these acquisitions are going to dilute the quality of Realty Income's portfolio over time and lead to greater risks. And then the fifth and final issue that I have with the company is that historically it has typically traded at a slight premium to most of its peers despite enjoying a slower growth rate. Before I continue, could you please do me a huge favor and like this video? That will really help me a lot to grow this channel, and also make sure to subscribe to the channel to not miss any of our future investment opportunities. Thank you so much. And so here you really need to ask yourself, why would you pay a premium to own Realty Income when you could buy a very similar business in the same sector at a lower valuation multiple and with a faster growth rate? I think that all of these issues are still valid today, they still exist, but one major thing has changed. Realty Income share price has crashed, and as a result its valuation is today a lot more opportunistic. Over the past 2 months alone, its share price has dropped by about 20%, and if you go back further in time, it's now down by about 36% in total, and that's despite growing its cash flow by about 15% over this time period, and so this essentially means that its valuation has been cut in half. So all of the issues that we highlighted earlier still exist, but at least now this is well reflected in the company's valuation and you're getting compensated for it. Before the crash, Realty Income typically traded at 20 to 25 times FFO, a low dividend yield of around 4%, but today you're getting it at just 12 times FFO and a dividend yield of about 6.2%, which is the highest in a decade. Its valuation has dropped so much that for the first time in its history, Realty Income is actually priced at a slight discount to most of its peers. I'll put a table somewhere on the screen, and there you'll see that it's now priced at a discount relative to Vici Properties, Essential Properties Realty Trust, as well as Agri Realty. To be clear, I think that this is how it should be. Realty Income enjoys a slower growth rate and therefore it should be priced at a slight discount, but at least now you're getting compensated for it in the form of a higher dividend yield and better margin of safety. Historically, a lot of investors have used the 5% yield mark as a buy signal for Realty Income. Well, today you can buy it at a 6.2% dividend yield, and while I may sound very negative about the company, there are actually a lot of positive things about it as well. The company has an exceptional track record. The management has more than proven itself. It has one of the strongest balance sheets in the REIT sector, which limits the impact of rising interest rate. And then I think that its business model is still well positioned to deliver roughly 4% annual FFO per share growth over the long run. 4% is nothing exceptional, but when you're yielding already 6%, that's all that's needed to reach double-digit annual total returns. And that's on a constant multiple basis. If, like me, you think that interest rates are likely to drop lower in the coming years, I think it's reasonable to expand some repricing as well as Realty Income returns to a higher valuation multiple and a lower dividend yield. Simply expanding from 12 times FFO to 18 times FFO could unlock 50% upside potential, and the company would still be priced at a discount to the multiple at which it traded prior to this recent crash. So how I see it here is that heads I win and tails I don't lose. If interest rates come back down as I predict in the coming years, then Realty Income has the potential to deliver deliver exceptional returns over the next 5 years. You'll get a high yield, steady growth, and some additional upside from repricing, and in total this could lead to 15 to 20% annual total returns for many years to come. However, if interest rates remain higher for longer as some other people are predicting, I think that the valuation is now low enough to still offer good margin of safety, and you'll still be able to earn about 10% annual total returns from the high yield and the steady growth prospects of the company. As such, I think that the company is now offering great risk to reward prospect for investors, especially considering that this is a mega cap blue chip type REIT. To recap here, I want to know that all REITs have pros and cons, and Realty Income is no exception. Our main issue of Realty Income has historically been its valuation, which has been above that of its peers despite enjoying slower growth prospects. But this issue now doesn't exist anymore. Realty Income is now priced at a small discount to its peers, which are themselves also heavily discounted. And so if you're a conservative, income-seeking investor, I believe that Realty Income is now a strong buy, and this is the reason why we own it in our retirement portfolio at High Yield Landlord and expect to buy more shares over the coming month. Now, if you want to gain access to my entire portfolio and all my transactions in real time, feel free to join my REIT newsletter High Yield Landlord for a 2-week free trial. I'll put a link to it somewhere in the description of this video, and otherwise, if you could please click the like button, that will really help me a lot to grow this channel. Thank you so much for all your support, and see you in my next one. Bye bye.